Okay, now we'll come to questions number 5. Now, if you look at these questions, it is totally different from the previous question in which they don't give you a proper statement of financial position, or they give you seems like it's just a list, okay? But then they give you an extract of your statement of comprehensive income. So in this case, this question, it need you to have some analysis, okay, before you go on to prepare the cash flow. So look at here, this is the information that you have, additional informations, okay, now depreciation charge as well as the shares. So most of the students, when they look at this, they seems like, okay man, I don't know where to start. So no worry, we'll do it together, okay. Now as I mentioned before, this one, share capitals, if they have nothing special, if you don't want to open this account, it's up to you, it doesn't matter. We can go, there's two methods, you can go through line by line basis, or you can go through this additional information. So for me, I prefer to go through the additional information, okay. So look at here, this is the information on the assets sold. So you have to open a disposal account. Look at this, you have 1, 2, 3 different accounts, and in your informations here, you have building, plant and machinery, vehicles, all at net book value. But when they give you information on the disposal, they are giving you at cost, okay. So here is at net book value, here is at cost. So when you prepare your accounts, okay, building, you can only prepare at the net book value version because you don't have the cost from here, okay. So this side, BD, we have the opening figure is 1400, and then the closing. Now since it's a net book value version, you will have depreciations here, not accumulated here. It's a current year depreciations here. Now according to the questions in the notes to account here, you actually have a disposal. So you have to key in here a disposal. Now, since it's on net book value, whatever figures you key in here should be on a net book value figures. So for building, your net book value will be 250 minus 155. So you should have a disposal of building 95. Okay. Now, current year depreciations. Now this is the profit and loss on this building, okay. Now next one, if you look at notes number 2, they actually give you the depreciation charge for the year. So now you have a depreciation charge for the year 105 for building. So here you will key in 105 for building. Here is the depreciations. So basically it means that here is 1,400 and here also 1,400. There is no purchase of building during this year. Okay, then we open a disposal for your building. Okay. Now during this year, the disposal for your building, if you look at here, you actually put in 95. And how much you have disposed, profit or loss, you actually made a profit of 20. This is the net book value building. Okay, net book value. So there's profit here. So it means that total cash received is actually 115. Okay. Now, okay, so this cash you will be using in your investment activities later, and this one on this side you have nothing that you really need to do except this depreciation figure you'll use in the operating activities later, and here the profit you'll use in the operating activities later. Now after building, you shall have, look at here, you have another plant and machineries. Okay, plant and machineries also net book value. So here BD, CD, this is the same. Okay, you will have the depreciations during this year. Plant and machinery is 205. Okay, disposal during this year, if you look at this, your plant and machinery original cost is 220, but you have disposed it for the depreciation is 1105, so the net book value is actually 115. Okay, now opening balance for your plant and machinery is 740, and the closing figures is 130. So the difference is basically your purchase. But bear in mind, if there is any revaluations, then you might have to put in the revaluations. But look at this case, they have no revaluations reserved here, so we'll just put it as a cash purchase. Okay, so the difference here, plant and machineries, is actually 410. This is your additional for the year. So purchase of your plant and machineries, this is your investment activities. Okay, same thing, you go for the disposal on plant and machineries. So from plant and machineries, you get a double entry here. Okay, now then actually here is 115. According to questions, you have a loss. Loss means is on this side, you have a loss of 30. So this is a loss. That means your cash received will be only 115 minus 30. The balancing figures will be 85. So this is the two figures you're using. Cash will be in investment, loss will be on operating. Okay, now next one, the depreciations also you need to go operating later. The next will be your vehicles. So vehicles, now vehicles, same thing, you have your opening. Okay, the format I think is quite similar, it won't change too much. So opening vehicles 420. Here you have 420, here you have 480, 485. Okay, during the year they told you that the vehicles has a cost of 120, but then when they dispose of, they actually has been disposed of. Then you look at here, the net book value is actually only 50. Okay, 50. So the depreciations for the year for this vehicle is 65. Okay, so you have 65 here. Now again, we checked just now, there is no revaluations, and it's impossible for you to have a revaluation of vehicles. Okay, so here you have 180 as the balancing figures. So this is for investment activities, depreciation is for operating activities, and here you have the disposal for vehicles. Okay, so here you have a vehicles, the cost is 50. According to the questions, you are making a loss. So you're making a loss, so you'll be on credit side loss here, and the cash should be the balance 40. Okay, so this will be your investment, because investment income, because you're selling, you get back your cash. And loss, this will have to previously minus from your income statement, now you have to add back to your income statement. Okay, because it's a non-cash item. Then look at here, do you have any payables? Account payables, this one not. Now you have this income tax liability. So tax accounts, okay, income tax account, it's a liability. So 100, 140 liability. So opening is on credit side, 100, and end of the year is 140. Now the concept for tax is like this: I have current year tax, I'll pay next year. Okay, so this is last year tax, this is current year tax. Now what's the reason behind it? It's always like this: when you prepare your income statement, it's already year end. Okay, maybe after 31st of December. So you prepare your income statement in February. So you will pay your tax. Okay, you will pay your tax next year. So the last year tax you are going to pay this year. So if you look at here, the income tax, this is current year tax, you are going to pay next year. So now, how much tax you have paid is basically, now this one you should put profit and loss, 140. And correspond with this and your tax year. Okay, this one, profit and loss. And the balance will be your cash, 100, you are paying for last year tax. Okay, operating. Now beside that, you have an increase in land, 500 to 570. Okay, at cost. So now we can prepare the cash flow. Okay, we can prepare the cash flow. Now I will prepare one by one in case you are not very sure, not very familiar with the format. Okay, now first one, we will have a profit before tax. Now profit before tax means after interest. Yeah? So here is profit after interest but before tax. So you're going to take these figures, 580. Here you have 580. Okay, now we are supposed to add back your depreciations. Now your depreciation, if you look at here, you have 1, 2, 3, which is similar with the one given here. So your total depreciation will be the total of these 3. Okay, depreciations will be 375. Okay, now after this you have a sales. Just now you have dispose of your asset, right? If you look at here, disposal, this one, profit and loss and loss. So if you look at this, profit is only 20, loss is 40 in total. So in total you have a loss on disposal. So this one, loss means previously you minus from your income statement, but now we have to add back because it is a non-cash item. So if after you net off, the figure is only 20. Okay. Then one more thing here, if you remember, we always have one thing we call it interest. Okay, now look at this, you have an interest here. Okay, interest is 63, and in your chart, in your list here, there is no interest, means that how much you have is how much you pay this year. So you don't need to adjust the figures. So now you add back, later on you minus it. Okay, so this is a profit. Here, before working capital change, you have 1038. Okay, now then we have to check on your account receivables and all this thing. Okay, here you have your account receivable 248 and 294. So there is an increase in account receivables. Okay, increase in account receivables. So the total increase in account receivables is basically 46. Now, increase in account receivable basically means that your cash with you getting lesser. Okay, because they are not paying you. Since they are not paying you, the cash that you have is lesser. So basically, increase in account receivable is a minus. Okay, so here account receivable we have done. Okay. Next, we have inventory 202. From 202 increase to 246. So increase in inventory 202 to 246. You have to minus 44 because your cash will go out to buy inventory. And the last one will be this one, account payable 167. From 167 decrease to 106. So decrease in accounts payable it's a decrease in your account payable. Basically means that you're paying off your creditors, so your cash flow is reduced. 61. Okay, so total cash flow you have is 887. So 887, this is your cash generated from operating. Now then after this you should have basically two items. One is tax, one is interest. So here you have interest paid. Now this year, since we don't have any interest payable, so how much you have initially, it will be the same figures. Okay, and then the tax, if you remember here just now, this tax, okay, you have a cash payment for your tax, so this is a tax payment, so minus 100. So after you minus 100, now the balancing figures that you have, cash flow from operating activities is 724. This is your cash flow from operating activities. So in total, this 724 you should put on next. Okay. Now you will have your cash flow from investing activities. If you still remember, just now we have a lot of I's here, right? I, 1, 2, 3, 4, 5, and one more thing. Here you have a land. Land is from your investing activities. Land increase means you have used your money to buy, so it go back to these categories. Okay, so purchase of non-current assets, it will be equals to 410 plus 180 plus the increase here 70. So this one 70, 410, 480, total you have to minus 660 because you used your money to buy the assets. Now, but when you sell your asset, you receive cash, right? So this is the proceed from sales of non-current asset. So you have 1, 2, 3. Total is 240. So now you have your cash flow. The net cash flow will be minus 120. This is a cash flow, net cash used in investing activities. Okay, and next, okay, now you have a cash flow from financing activities. So financing is always equity and long-term loan. So if you look at this, share capitals, proceed from share capitals. Now here it's from 1008 to 2000, and here is from 400 to 200. So it's an increase and it's a decrease. Okay, it's an increase and it's a decrease. So we'll put into two different accounts, different things. Okay, proceed from sale of share capitals is actually 200, and then you have a premium from 40 to 140. So you have a proceed from share premium 100. And then this one you have redeemable preference shares for 400 to 200, means you buy back, they have redeemed back their shares, you have redeemed back your shares. So it's a redemptions of shares, preference shares. So it's a minus 200. Okay, then here you have a next, you will have your dividend paid. If you still remember, oh, I think we made a mistake here. It should be financing. Oh no, yes. This is a financing activities. Where's okay, now if you look at here, you have this building. We have been using this figure, so this one we're done with it. Okay, cash at bank we'll use later. Income tax liability we have done with it. Bank overdraft. Long-term loan, okay, 600 to 630, 350. So your loan you have pay back, okay? So it's a repayment of loan. Actually, you have been paying back 250 from 600 become 350, so it's a paying back of 250. Now you still have one dividend payable. So this one we should open an account for it because it's a payables account. Now we'll combine two ordinary and preference. So BD will be 210, and then your CD according to questions, CD is 215. Okay. Now dividends payables always relate to your retained earning account. Okay, retained. So now if you look at this, your opening retained earning for current year is actually 213, and then closing is 438. So basically here you have CD. Now during the year, the profit that you have earned, profit for the year is 440. So this is profit and loss figures. So dividend, the balancing figures will be your dividend figures normally. Okay, this is 215. So here from retained earning, you minus again the dividend for current year, 215, and you pay dividend for last year, cash. Okay, so this will be your financing activities. Okay, so now here you should have one dividend. And now if you want to put your dividends in your operating activities, it's also allowed. Because dividend is flexible, you can put under operating, you can put under financing. So now your total net cash flow is actually minus 360 from your net cash used in financing activities. Okay, so what's the total changes? So net, if you look at here, minus this, you should have a minus 56. So this is a decrease, net decrease in cash. So what's the opening? So here if you look at this, we have been using it. The only thing that we are not using now will be cash, and this. All this have been used. So overdraft, there is no overdraft, means that your opening is 20. Opening cash flow is 20. Then your closing, you have 36. Bank overdraft, the minus sign, 36. So you can double check. Negative 56 minus 20, you add 20, then equals to 36. So this closing cash flow. Okay, so that's all for today for this question number 5.